Hey guys, this is your host, and in this lesson, we are going to learn about capital asset pricing model. So let's get started. So what is capital asset pricing model? The capital asset pricing model, or the CAPM, is one of the most important concepts in finance. It shows the relationship between the risk and the expected return for an investment. According to the CAPM, the expected rate of return for an investment should equal the risk-free rate of return plus a risk premium that is based on the beta of the investment. Simply put, it means that higher the risk, higher will be the expected return. In this lesson, we are going to learn about the formula for calculating the expected rate of return using CAPM. Let me explain the formula. Now, before we dive into the formula, let us learn about few terms. So, term number one is risk-free rate of return. Risk-free rate of return is the minimum return that an investor needs to earn on his investment. This is also called as the cost of capital. It is the rate of return that can be earned by investing in a risk-free security such as a government security. The government securities are considered to be risk-free because they are backed by the full faith and credit of the government. Next term is the market risk premium. Market risk premium is the difference between the expected rate of return of the overall market and the risk-free rate of return. It is the additional return that an investor requires for investing in the stock market, which is considered to be risky, compared to a risk-free government security. Next term is beta. Beta is a measure of a stock's volatility in relation to the market. In other words, beta measures the systematic risk of a stock. It is calculated by measuring the slope of the regression line of the stock's returns against the market returns. If the beta is greater than 1, then the stock is considered to be more volatile or riskier than the market. For example, if the beta of a stock is 1.5, then it means that the stock is 50% more volatile than the market. If the beta is less than 1, then the stock is less volatile or less risky than the market. For example, if the beta of a stock is 0.5, then it means that the stock is 50% less volatile than the market. Okay, now that we have learned about these three terms, let us see how these three terms are combined together to calculate the expected rate of return using the capital asset pricing model, or the CAPM. So, the formula for the CAPM is given by this equation, where E is the expected rate of return, RF is the risk-free rate of return, RM is the market risk premium, and beta is the beta of the stock. So now let us understand the formula. So first we need to add the risk-free rate of return and the product of the market risk premium and the beta of the stock. So first we multiply the market risk premium with the beta of the stock, and then we add it with the risk-free rate of return. And this sum is the expected rate of return. Let me show you an example to make this more clear. Assume that the risk-free rate of return is 6%, the market risk premium is 4%, and the beta of the stock is 1.2. So here the expected rate of return will be 6% plus 4% multiplied by 1.2, which is 6%, plus 4.8%, which is 10.8%. Therefore, the expected rate of return for the stock is 10.8%. Let me show you another example. Assume that the risk-free rate of return is 7%, the market risk premium is 3%, and the beta of the stock is 1.5. You might be wondering, why do we use this formula to calculate the cost of equity? Well, let me tell you. The cost of equity is the minimum return that a company must earn on its equity investments to satisfy its investors. It is also known as the required rate of return. It is calculated using the capital asset pricing model because the CAPM is a widely accepted theory that explains the relationship between the risk and the expected return. Here is the formula for calculating the cost of equity using the capital asset pricing model. Cost of equity is equal to the risk-free rate of return plus the product of the beta of the stock and the market risk premium. The market risk premium is calculated by subtracting the risk-free rate of return from the expected rate of return of the overall market. Now let us take an example to understand this concept better. Let us assume that the risk-free rate of return is 7%, and the expected rate of return of the overall market is 11%. The market risk premium will be 11% minus 7%, which is 4%. Now, let us assume that a company ABC has a beta of 1.2. Using this information, we can calculate the cost of equity for company ABC. So the cost of equity will be equal to 7% plus 1.2 multiplied by 4%, which is 7%, plus 4.8%, which is 11.8%. Therefore, the cost of equity for company ABC is 11.8%. The cost of equity is used by companies for making investment decisions. A company will only invest in those projects whose rate of return is more than the cost of equity. In addition to the cost of equity, the cost of debt is also considered while making investment decisions. The cost of debt is the interest rate that a company pays on its debt. Companies try to maintain a certain debt-to-equity ratio while making investment decisions. The debt-to-equity ratio is the proportion of debt financing to equity financing. Alright, so let us learn about the formula for calculating the weighted average cost of capital. Weighted average cost of capital is the average rate of return that a company expects to earn on its investments. It is calculated by taking into account the cost of both debt and equity. Here is the formula for calculating the weighted average cost of capital. Weighted average cost of capital is equal to the product of the cost of equity, and the weight of equity plus the product of the cost of debt and the weight of debt. The weight of equity is the proportion of equity financing in the company's capital structure, and the weight of debt is the proportion of debt financing in the company's capital structure. Let us take an example to understand this concept better. Let us assume that the cost of equity is 11.8% and the cost of debt is 6%. Further assume that the weight of equity is 60% and the weight of debt is 40%. So the weighted average cost of capital will be 11.8% multiplied by 60% plus 6% multiplied by 40%, which is 7.08%, plus 2.4%, which is 9.48%. Therefore, the weighted average cost of capital is 9.48%. Companies use the weighted average cost of capital for making investment decisions. A company will only invest in those projects whose rate of return is more than the weighted average cost of capital. And that's all for this lesson. I hope you have learned something new. Please let me know your feedback in the comment section below. Thanks for watching, and see you in the next video.